Hello, my name is Lindsay Shuck. Thank you for joining today's Family Office Network's webinar series featuring AIR Asset Management. Richard Beleutz, Chief Executive Officer, and Scott Romanek, Managing Director of Sales and Marketing, are with us today. At the end of our presentation, we will have time for Q&A. We encourage you to use your questions chat option on your screen to send over any questions during the presentation so we can answer them accordingly.
Thank you so much, Lindsay. Certainly appreciative to Family Office Network to be able to participate in this today. Welcome to our attendees. Really happy to be able to speak and shed a little bit of light on our asset class, a very unique asset class, and in a lot of ways, maybe a misunderstood asset class. So we certainly hope by presenting today that we can definitely shed some more color on the opportunities that are presented by these type of investment strategies. So I'd like to start by just, my name is Scott Romanek. I'm the Managing Director of Sales and Marketing for AIR. And I'd like to give you a little bit of a background on AIR and who we are. AIR Asset Management, AIR is an acronym for Alternative Investment Resource. We are experts in the longevity-based investing space. I will get into, in the next slide, what longevity-based investing means. There are certain components to it that we will discuss. AIR is a SEC registered investment advisor. We are currently at approximately $325 million in asset under management. We are also the U.S. strategic partner of Carlyle Management, which is a roughly $2.5 billion asset manager solely dedicated to the life settlement space. We do believe that that is certainly one of our edges and one of our strong suits is to be able to have a strategic partnership with one of the preeminent and leading life settlement managers in this asset class. We pride ourselves on very, very stringent internal standards as far as our reporting, our operations, and we certainly feel that that we are an institutional class manager in this space. So with that said, let me go into longevity investing. So what is longevity investing? The most obvious component of longevity investing is a life settlement. Life settlement, and again, we will break down these components, but I do want to give you an overview. Life settlements are basically the purchase or sale of a unwanted or unneeded life insurance policy. Essentially what happens is seniors who in many cases need liquidity to meet certain needs in life decide that they would sell a policy. And what happens is investors then will bid on these policies and offer a price and will pay their premium payments until they pass away, at which time the investors then collect the death benefit. What we call the face value and death benefit of a policy. That is not the sole component of longevity investing. Something else that we participate in is annuities and structured settlements. And what happens here is it's essentially where a plaintiff, typically these are personal injury type cases, where a plaintiff is awarded a settlement. And many times what happens is they are awarded what we call a life contingent annuity, and that annuity is taken out by the defendant in the case that then will fund these future payments for the remainder of the life for the individual. And typically what they'll get is they'll get a monthly payment. What happens is that over time, a lot of these folks, their needs may change, and rather than getting a monthly payment, they would prefer to have a lump sum. What happens in that case then is that they will go to a court, they will get what's called a court-ordered structured settlement, and then again, similar to the process of a life settlement, we will then, or investors will bid on that revenue stream. The reason that we really like the annuity and structured settlement space is that in a lot of ways, it's a very complementary strategy to a life settlement. With a life settlement, you are essentially short mortality, meaning the sooner that the individual or the policyholder passes away, you then can collect that death benefit. And you are also on a monthly basis, you are paying out a premium to keep that policy in force. It's really the inverse with an annuity structured settlement. We are purchasing a cash flow positive revenue stream, and we are long mortality because these folks, we will receive that revenue stream for the remainder of that individual's life. And these folks are much younger than the person who's your typical life settlement person. Typically, life settlements, to be eligible, they say 65 or older. We tend to focus, which we'll get into strategy a little bit later, we tend to focus on those folks that are probably 75 or older. The individuals who we purchase the annuities and structured settlements are much, much younger. They're typically on average in their 40s. So we have a long time to connect or to collect that revenue stream. And then the last component is what we call the life insurance backed lending. In a lot of ways, this mimics a private credit type situation. And really what happens here is this is where an individual, a policyholder, does not want to necessarily sell their life insurance policy. What they'd rather do is they'd like to borrow against it. And it's an option that the insurance companies do not give them. And so many of these folks who are typically terminally ill, usually the term of these loans is no longer than 5 years. They will borrow against their policy, and it's advantageous to them for 2 reasons. Number one, it's a non-taxable event because they are not selling their policy, they're simply borrowing against it. And number 2, when they pay back the loan and any accrued interest, there is a retained death benefit for their heirs. So it is a nice option for those that do not want to necessarily sell their policy. So those are the components of this longevity-based asset class.
Yep, and just a point of clarification, they're borrowing typically off a life settlement value. Sometimes insurance companies, you can borrow off the cash value, but what we do here is support that.
Thanks, Rich.
So next thing I want to get into is longevity investing and where it fits in the portfolio. Longevity investing can fit in a lot of places. I've seen it in fixed income, alternative fixed income. Obviously it's an insurance dedicated type of or insurance based type of investment. I've seen folks classify it as esoteric market neutral. But the most common place that the bucket that this gets put into is the private credit bucket. And it really fits into the specialty finance area of private credit. Private credit is a very large alternative asset class. It's one of the largest next to real estate. And it covers private lending for real estate, subordinated debt, distressed credit, and then there's a sector of specialty finance that has kind of the esoteric aviation finance, music and royalties are a couple examples of other esoteric in the specialty finance arena. And those investments under the specialty finance, trade finance would be another, tend to be very non-correlated, and they tend not to be impacted by effects of the broader markets, and we'll get into that in a little bit. So that's kind of the classification. Next, Scott's going to go through what are life settlements.
Sure. So what is a life settlement? Why does this asset class really exist? It's quite unique. Again, in many ways, a little bit misunderstood, but we've found that over time, it has really become an attractive asset class because historically, when managed properly, the asset class has produced uncorrelated positive returns. And so it's really become in a lot of ways undeniable to investors and particularly institutional investors. So the life settlement, as I stated before, is really, it's the transfer of ownership of the death benefit of a policy. So typically what would happen is a senior I do want to point out the fact that the reason that this is attractive for seniors to do is that, shockingly, 80% of Americans have less than 1 year's salary as savings, and a staggering 40% of people have no savings at all. Many, particularly seniors, are ill prepared for retirement. And what a life settlement does is it provides these folks an opportunity to monetize an asset that in many ways they were unaware that they even possessed. And so what happens is there's life settlements are they're regulated in 46 states, and we'll get into the sourcing a little bit later. But these seniors will typically they'll basically shop what the value of a policy will be, and hence when an investor buys it, they no longer have to pay their premium payments. Really, kind of one of the reasons that they initially may enter into a life settlement transaction is because as you do get older, and as you may start developing impairments, inevitably those premium payments will increase. And unfortunately, there's a slide on this later, but there's over $21 trillion of life insurance that is in force in the United States. Up to 90% of that will basically lapse without an insurance company having to pay out a benefit. And what this allows them, these policyholders, to do again is to monetize that and essentially have acquire a amount of money that can help them meet their needs for future lives. Life settlements, win-win for consumers and investors. There was a report done in 2014 by the London School of Economics that basically had determined that this is, for seniors, provides them an opportunity, again, that an insurance company simply will not give them. Usually what will happen is that the cash surrender value of a policy, life settlements provide up to 7 times what the cash surrender value to an insurance company is. And most times people won't even cash out the cash surrender value. What they'll do is they'll keep the policy in force and run off that cash surrender value. So what this London School report found was investors can buy these policies, and that there's an opportunity for them to again to profit when the person passes away. So one of the things that has made this asset class currently a lot more acceptable is the fact that it is viewed as a socially responsible investment. Reason being is that you are providing these seniors much needed financial independence. Again, many being ill prepared for retirement, and this is a way for them to essentially fund many things going forward in their lives, including long-term care. So it's definitely a beneficial, again, viewed socially responsibly, and ourselves and our partners adhere to what we call principles for responsible investment. We are voluntary signatories of PRI. And what PRI is, it was established and adheres to 6 principles that were recognized by the UN that meet these standards. And in order to be reviewed for PRI, you must meet, and your investment strategy must meet those 6 criteria, of which ourselves and Carlisle are both participants. So Rich, if you want to talk a little bit about the sourcing and how a transaction actually occurs, I think that'd be helpful for
Great. Thanks, Scott. So I'm just going to walk through the basic stages of transacting a life settlement. Before I get into the actual transaction, I really want to define the life settlement marketplace. There's the primary market for life insurance, and that's when the life insurance agent sells the policy to the insured for the first time. That's the primary market. There's a secondary market, and that's when the insured decides to settle the policy, either direct to some type of direct-to-consumer program or through a broker, a licensed life settlement broker. 46 states are required to have licenses to settle policies. And then there's a tertiary market. The tertiary market is an investor-to-investor market. Let's say that senior settles their policy, and that investor that bought the policy now wants to sell it for whatever reason. into the broader market. That's called a tertiary transaction. A lot of times the tertiary trades, they can be done one at a time, but typically they're done in portfolios, small, medium, or large. So from a sourcing perspective, there's two ways in the secondary market I touched upon briefly. One is through a network of licensed life settlement brokers. There's three primary life settlement brokers out there that do the majority of the brokerage business, and they have established specialties in dealing with the financial intermediaries out there, which are the broker dealers, the insurance agencies, the estate planners, the accountants, and other financial professionals that want to help their clientele get a better price than the cash value for their life insurance policy, or sometimes just to simply get a quote for valuation perspective when looking at balance sheet assets and potential liquidity. And those tend to be, they can be what we call small face, which is less than $1 million death benefit, but they tend to be larger policies, 1 to 10 million, and they can obviously go above 10 million for what we call large face policies. Those are kind of the three categories of policies. There's a number of direct to consumer programs out there. You may have seen advertisements on TV, print, media, etc. That's where there's typically an 800 number that a consumer would call and say, hey, I have a $500,000 policy and I want to see if there's any value to it. The direct consumer program typically will offer some type of price based on basic information. Those direct to consumer programs tend to transact in the smaller range. But they can transact at all sizes as well. So you have direct to consumer, and then you have the brokerage market. That's really the sourcing through the secondary, and that's when it doesn't have to be a senior, but typically seniors settle policies. Tertiary market, that is transacted investor to investor. So when an investor buys, then when we go back to secondary, when they buy a policy through the brokerage community, they're required to do that, or if they buy it direct from a consumer, they're required to do that in 46 states through a licensed provider, whether a captive or a third party. In the brokerage community, the brokers typically call on the providers. The providers are the buy side representatives for the asset managers. And policies tend to transact a lot like they do in real estate. I'm going to touch on the tertiary, then I'll get into the underwriting and closing process. Tertiary transactions are investor to investor. So, there's, call it a couple of dozen, meaningful investors in this space that have investable products. And then there's, dozens and dozens of other investment pools and balance sheet investors. So it's a relatively small market from a number of participants standpoint. And so when folks are looking for liquidity, there's a relatively known network of folks that they can go out to in what's called the tertiary market. There's new entrants into the space all the time, and obviously folks sometimes will exit the space, and there's more liquidity right now in the tertiary market than in the secondary market. So it allows for actively managed hedge funds like ours to trade policies for capital gains, as opposed to simply holding them to maturity and getting ordinary income. We do a blend of that, and the more sophisticated active investors in this space have some type of trading component for profit. Other more passive investors just liquidate when they have redemptions. So that's just a little style difference between some of the top managers and the rest of the field. In terms of underwriting, so we're going to go back to the underwriting process, and I'll use a secondary market example. So let's say I'm a 78-year-old senior. I have a $3 million life insurance policy, and typically the market's traded in universal life. You can do some convertible term or whole life, but the majority of the life settlement market is universal because of the flexibility of the universal life insurance contract to pay low premiums and make do something called premium optimization, where you minimize your payment and obviously which minimizes your ongoing cost of carry, which enhances your returns. So let's say I have a $3 million universal life insurance policy that I want to settle. I call up my accountant and I say, okay, I got this policy and you know, I don't want it. My kids are growing up. I don't need it. I'm tired of paying the premiums. And what are my options? There's really three options. Number one is you can elapse the policy and take whatever cash value is left out of it. You know, number two is you can just simply let the policy run off, let the cash value continue to pay premiums until the policy lapses. Or number three, you can do what's called settling the policy, or you can sell it to a third-party investor. So my accountant might say, hey, you know, let's say you have you know, $30,000 of cash value left. You know, potentially, you know, there's value. You can take the 30 grand, or you can see if there's value in the marketplace. Go out to the marketplace, and you know, let's say I'm in pretty good health as a 78-year-old, 15-year life expectancy. I go out and see if there's a price in the market, and they come back. You know, I'll just use the average of 7 times cash value. Comes back and says, okay, there's you know, for 210,000, somebody would sell the policy. And so I decided that's a good deal. It's found $210,000 that I didn't know I had. So I sell the policy off. What the investor does is they will get the insured to sign off, you know, a HIPAA release form that allows for the life expectancy report to our actuaries to go in and access all the medical records and do what's called a life expectancy report, which gives a lot of interesting kind of data on the longevity attributes of that individual. They go through and do an underwriting, you know, using the very same criteria that the insurance company did, let's say 20 years ago when I got the policy. You're just re-underwriting now at age 78. And obviously there's a chance that my health condition changed in the last 20 years. And so based on that, there can be an arbitrage in the cost of insurance pricing, which means that it's good for the investor because they have found money, or they can buy a policy at a pretty good IRR. IRRs in the space are anywhere from the high single digits into the 20s. Average could, depending on what kind of policies we're talking about, could be in the low double digits to mid double digits. Those are pretty good IRRs. So that underwriting process allows the investor to get a feel of the probability of cash flows over time. Then there's the valuation and pricing, which is basically a discounted expectation of cash flow. The market is typically traded on what's called a market rate or a discount rate or an IRR. And from that discounted expected cash flows comes a price. Once price is determined, then you go into the closing process, and it's there's escrow, there's closing packets are 1,000 pages, much like a real estate. It's a complicated process. It can take months, and that's why it's important to work with an experienced life settlement broker or through obviously a licensed life settlement provider.
Rich, can I interject something just to give the audience a little bit of perspective about pricing? Typically, what a life settlement provides these individuals is investors try to buy policies anywhere between 10 to 20% of what the face value of the policy will be. So on $1 million death benefit, it's anywhere from $100,000 to $200,000. Now, that's not a hard and fast rule. It's simply kind of a rule of thumb. And what you need to do, and Rich alluded to this, is the most critical component in the pricing of a policy is determining what that life expectancy of the underwritten is, what the life expectancy of that policy holder is, because that is going to significantly affect your cash flows. And obviously, none of us have a crystal ball, and we do not know how long someone is going to live. But by obtaining those medical records and adhering to what actuarial type of data tells us, we can make a very good assumption within reason of what that person's life expectancy will be. And I do want to point out one key component to this that Rich touched upon, which is the fact that particularly our strategy itself does not rely solely on the purchase of a policy and then harvesting a death benefit. There is an opportunistic component, particularly to what we do, and not all life settlement managers do this. But that opportunistic component is the purchase of a policy that we can buy at a very good internal rate of return. And subsequently, what we can do is we will essentially harvest the policy for a period of time. And that 78-year-old individual over time will eventually develop impairments, where in the marketplace, we may have other life settlement managers who view that policy as more valuable now. So what we can do then is we can sell that policy into the marketplace, not necessarily have to worry about harvesting the maturity and being just a straight buy and hold strategy. And we've done one major thing in that transaction. We have now transferred the life extension risk, which is the #1 risk in the space, to another investor. And essentially, we've created a realized gain within our portfolio.
Yeah, that's what Scott's talking about, is the seasoning effect. And there's a lot of things that sophisticated life settlement asset managers can do to enhance value in a policy. From cleaning up data files to buying, having an edge on sourcing, buying cheap, holding, providing inventory to the market when it needs it, taking inventory off of market participants' hands when they need liquidity, and you get a pricing edge for all that kind of stuff. So there is an advantage to acting like a market maker or having a trading component to an actively managed life settlement fund, which is something that we do. And I want to come back one more thing on the pricing, and I want to move it forward. But the key on the pricing is, I think we touched upon this in a couple of different ways, but obviously, depending on the life expectancy of the individual and the level of impairments and the cost of insurance and the age dictates the price. Like Scott said, the majority of the transactions that we do are kind of in the secondary market, kind of tend to be in the 10 to 20% range. If somebody's healthier, it's less. If somebody is less healthy, I mean, you can go all the way up to 70, 80% of the death benefit if you have somebody who's uber impaired. So it does range. Life expectancy is a very difficult thing to predict, and so one of the obviously you can put 10 doctors in a room and you can ask them what the life expectancy of an individual is, and you get 10 different answers. You put 10 actuaries in a room and you get a tighter band of information. And so one of the things that we like to do is we like to look at the policies from an actuarial standpoint. And we find that yields a higher degree of predictability. And that's also how the market tends to price policies, and valuation policies tend to value policies in open-ended fund structures. And so it's the way that we approach the asset class. And we feel it's a strong differentiator.
Yeah, so I think that, Rich, that's a good transition then to kind of the size of the marketplace. Many investors want to know, it is essentially, it's a capacity constrained space. It's a niche space in many ways, and quite frankly, there's more money and more investors that are interested in participating in this asset class than there are actually policies available. And as the asset class itself has become more desirable because of those non-correlated returns, I mean, everybody in the audience right now knows that there's really a struggle for yield in a lot of ways. Certainly we had a rebound in the equity markets, and that's been evident. We've had a strong equity market over the last decade, but many investors are looking to get defensive and are definitely trying to rebalance their portfolios in order to achieve some sort of a non-correlated type of diversification to their portfolios. So again, sort of capacity constrained, which has taken that market rate down, which is essentially the yield that generally that the policies in the marketplace will achieve. And folks are willing to pay a little bit more now for policies in order to achieve that non-correlation. That said, again, and the number that we have on the top here with 17 trillion in existing life insurance policies, as I stated earlier, it's about 22 trillion that's in force. Again, 90% of that, up to 90% of that can essentially lapse without a payment from the insurance companies. So, and this is a key point that I'd like to point out, because I'm sure there are people in the audience who say, well, insurance companies must hate this, which can be true. Some insurance companies actually do participate in the space, you know, in some ways as a hedge. It really is, as far as insurance companies are concerned, it is a very small sliver of their overall balance sheet, what these policies or what a life settlement actually forces them to pay out. But what I wanted to point out was this asset class actually dates back to a 1911 Supreme Court ruling called Grigsby versus Russell. And what that Supreme Court ruling essentially determined was that life insurance is considered an asset, it is considered property, and therefore it's transferable. So as long as that Supreme Court ruling is in place, this asset class is secure from there not being able to be participants of purchasing and essentially taking becoming the beneficiary of someone else's policy. So size of the market, right now we're looking at between the secondary market, which is where Mr. Smith sells his policy for the first time to an investor, and then the tertiary market, which is the investor to investor market. Because there is no actual tracking or empirical data on this, we do have, you know, anecdotal type data from the Life Insurance Settlement Association. LISA is the acronym for that. That says that it's roughly about 10 billion in the secondary market and 10 billion in the tertiary market currently. But what's happening is there's an education process going on amongst seniors, and many folks, and we've actually determined that it could be up to 75% of the people who are eligible for a life settlement are actually even aware that this is an option for them. Subsequently, what's happening is in some states, Florida being one in particular, folks are, I should say insurance companies are being required to notify folks whose policies are going into lapse or are in jeopardy of going into lapse that a life settlement is an option for them. So as a result of that, and you take the fact that you have an aging baby boomer population, we think that we're roughly 3 to 5 years away of the sweet spot of baby boomers moving into that eligibility range for a life settlement. Basically, what we're looking at then is we anticipate between the next 5 to 10 years that going from 20 billion in total death benefit that transacts annually, it could approach 60 billion. And what that's going to do, that increase in supply, is essentially going to increase higher yields for investors, because basically you'll be able to get better pricing, more favorable pricing for a policy, and then create a better return for the investor.
So next I want to focus in on how investors are compensated for taking risks. And I just did a real generic example here with some basic numbers in terms of how a policy is priced from an IRR perspective and what the breakdown of risk is. So if we take an example of a policy with a market rate or an IRR of 12.5%, well, what's the risk breakdown? If we take a look at the number one risk, which is mortality risk, that's about 5% of that. So it's a significant portion of the overall risk that you're getting paid for. As I mentioned earlier, you can't know exactly when a policy is going to mature. You tend to have higher understanding of When you have a pool policies, they tend to be the pool tends to be more predictable when you hit these diversification thresholds. But there's some variability or risk in there, and that's the number one risk in the space. The number two risk is all the esoteric industry related risks. It could be things like sourcing risk or other types of risk that's just esoteric and it's very specific to the asset class. You move into the liquidity risk. These are level 3 assets. They're traded over the counter. Yes, there's billions of dollars of liquidity that's transacted in the tertiary markets on an annual basis, but tertiary markets and over-the-counter markets, they're not like exchange traded assets, so you get a premium for that, and it's about 2%. If you take a look at the credit risk, it ranges from low-rated credit insurance companies to high-rated. In average, maybe you're getting 1.25 points on the credit risk. There's never been a valid life insurance in the history of the United States that's failed to pay out a death benefit. So we think that the credit risk is just you're getting really paid more on if there's an insurance company that's not doing well. And it's like Genworth, for example, which had a lower than investment grade credit. There's just not as many people in the market that will buy those. So when you're looking to sell those, you're not going to get as good of a price. And so you're getting paid for that. And then, obviously the risk-free rate, the quote we have in here is a May, and that's, gone down since. But that's just the composition of the different components of risk, if you're wondering what you get paid for.
Rich, I just want to elaborate a little bit on that credit risk, because I want people to truly understand why we're comfortable with that risk. We really feel that risk is worth taking, that it's a negligible risk in our eyes, and for part of the reason that Rich had alluded to, that anytime there's an insolvency with any insurance company in history, another usually larger insurance company comes along and acquires their book of business. There has never been a death benefit that's been failed to be paid by an insurance company. And in fact, when an insurance company, if they do incur a bankruptcy, what happens is these death benefits by law become senior to any corporate debt. So they are required to be paid. And there is a final backstop to that, which is called state guarantee funds. And these state guarantee funds act much like FDIC, where if there is, for whatever reason, an inability by the insurance company to pay, which again, I will stress has never ever happened, then these state guarantee funds will step in and pay up a good chunk, a good portion of what that death benefit is. And that's never had to be utilized or tapped.
Yeah, these state guarantee funds are unfunded liabilities of the states. So what they do is every time a premium is paid, they get a little piece of that. And then they just put it into their general budget, spend the money on whatever. And so this, that's the reason why the regulators in the states always transition these books of business rather than letting insurance companies to go under, because they'd be on the hook for $300,000 to $500,000 per policy. So we feel good about that risk. We're in start thinking of your questions. We're almost wrapped up here. And we're gonna cover I'll cover real quick, and Scott and I'll cover real quick at just some of the COVID impacts on the industry, and then we'll open up for questions. We get this question a lot. Obviously the COVID has an indirect or has a direct impact on the senior population. Just anecdotally, what we've seen out there is we have seen an uptick in the number of mortalities out there, both COVID and non-COVID related this year in our books. There's some, Scott will go through some industry stats and so forth. But what we've also seen is they tend to be on smaller policies, and that effect has really kind of withered away. It was really more in the front part of the event. So it's really turned out to not have a major impact one way or the other on the industry, which is obviously fortunate for our senior population. And Scott can go through some some of the impacts on the stats, but in the secondary market, because of social distance, there's been a slight activity reduction. but through mobile escrow agents and technology and people just getting used to the world that's going on, that's kind of started to resume normal activity. And the direct-to-consumer channels, that we've seen a little bit of an uptick in advertising and volume as people are looking for, potential liquidity in the space. But overall, it's kind of, been not a major situation.
Yeah, and I'll elaborate on that a little bit, Rich. What we have found, and very early on in COVID, and this was basically back to the beginning of March or mid-March, there was a report that was put out by an independent medical underwriter. And these independent medical underwriters are who are utilized typically to determine what those life expectancies are of the individuals that enter into a life settlement transaction. What they found was, and they did some estimates because obviously it was early on, and they said at 275,000 US-based deaths that they determined through their research that they anticipated 1 in 1,000 policyholders being affected. So as of today, I believe we're at roughly 170,000 deaths in the US. Rich did mention that we have seen an uptick, particularly in smaller face policies, which is designated as anything less than $1 million death benefit or less. And part of the reason we think there is what we refer to as the wealth factor. Those who have larger policies are typically deemed more wealthy, that may have a better exposure to healthcare. And those folks, we just have not seen that increase, again, in preliminary data. And so we, at the stage that we're at now, obviously a little bit early, and I think people are going to certainly analyze what's been happening for the time to come. The impact has been a little bit negligible within the life settlement marketplace, but it is something that is being currently evaluated and watched.
And yeah, here we have some charts here.
Well, and what this shows really is that obviously 85 years old or older has been disproportionately affected by this virus, and that is the population most affected by this. And again, life settlements probably, we're looking at seniors that are usually eligibility is 65. Typically, we like to say it's probably 70, and the meat of these folks is roughly between that 78 to 82 range. So again, we're looking forward to more data going forward on this.
And I think at this point, there's our team. I think at this point, we'd love to open it up for questions.
Thank you, gentlemen. To all of our attendees, again, please utilize your questions chat option on your screen to send over your questions so we can jump right into it. First question, what is your relationship with Carlisle and how do you work with them?
You want to take that?
Yeah, so Carlisle, this is an independent asset manager based in Luxembourg. That's Carlisle with an I, not the big private equity and hedge fund manager out of DC. That's multi-$100 billion group. So Carlisle, they're a strategic partnership. So for tax reasons, they don't have any presence in the U.S. They're launched out of Luxembourg because their initial investors were European, and so we've created feeder funds into their products, and then we also have our own products. We sub-advise them on their products. They advise us on ours. So that's the relationship with Carlisle. They're the top performing manager in the space, one of the largest independent managers in the space, and they're a partner.
Great, thank you. So next question, if the market sizes increase mainfold in the next 5 years, will the IRRs decay due to the competitive pricing?
No, we actually think it's the inverse. We think that if there is more supply that comes to market, that investors like us are going to have more favorable pricing on policies. Hence, we think the IRRs will increase because, again, viewing this as a viewing each policy as a financial instrument and viewing it quantitatively, we're able to, with much more supply out there, essentially pick and choose the policies that meet the criteria that we want, which is generally IRR driven. And we're able to bid on those policies and be much more favorable from the investor standpoint. It would be the inverse, and what's been happening in the space over the last 10 years is that returns have come down. You would see in our performance fact sheet, particularly of our partner who's had a $2 billion fund. It wasn't always $2 billion, it is currently. But over the last decade, you would see that there has been contracting returns. And it's exactly a function of less and less supply due to much more institutional demand and assets flowing into the space. So increased supply is going to be advantageous to fund managers like ourselves.
Great, thank you. Let's see, next question. How many insurance policies are in your offering, and how diversified are the various risk factors within that bundle?
That's a great question. And obviously, in this format, we can't get into specifics on any of our funds. We do have an array of different fund products, both open and closed end. So happy to get in that with prospective folks individually. So if you have interest, obviously, please reach out to us and we'd be happy to address that. But, we're obviously very diverse in terms of policy count and insurance carrier and all that kind of stuff.
And if any individuals are interested in pursuing a little bit further, we have a detailed investment deck that spells out the specifics of the strategy, how we approach the asset class, and obviously a performance history. And as Rich said, we do have multiple different products. And I'll give you an example. The difference between an open-ended hedge fund structure and the closed-end hedge fund structure, for those who may not know, is in an open-ended hedge fund structure, you do have monthly subscriptions and you do have a monthly net asset value, and profits are reinvested on a quarterly basis back into the portfolio to increase that compounding effect. Whereas in a closed-end structure, the capital is called in a particular period, and then the capital is then deployed where policies are purchased, and essentially a closed-end product will distribute profits back to investors rather than that reinvestment. So we do have performance metrics on the different fund structures that we have, all of which I would say have been very, very strong.
Perfect, thank you. This question's a little bit detailed here. It says, if changes in administration and differences in return, question mark, maybe he means, are there going to be differences in returns? Also, as mentioned in 2008, majority of life settlement cos went out of business. How is AIR protecting itself? And is there any chance this could happen again due to the liquidity crisis that might be coming up?
So I'll go back and we'll go through a little history lesson of the life settlement space in terms of market rates and market participants. And I'll talk about kind of the Great Recession period, and I'll talk about today. Obviously, the short answer is there's always risk in any investment in any market, especially with kind of the unknowns that occur. So there's always risk. It's just how do you assess the size of the risk and the relevance. So in the early 2000s, the market participants tend to be a lot of private investment pools. What happened is the large investment banks got into the business. So, Bear Stearns, also you had banks like Commerce Bank, you had, AIG, you had Credit Suisse, you had a huge fortress, you had a large number of what I'll call leveraged, securitization companies that came into the space and had life settlement desks. So the big investment banks, namely. You also had a ton of bank leverage for premium finance. You also had a lot of STOI, so you had a lot of product production, and you had very loose regulation at that time. So you had a huge boom in the life settlement marketplace. So the marketplace was really, it was created with the 1911 Supreme Court case, but it was really established in the 1980s through the AIDS epidemic. In the 90s, the senior life settlements came about. In the early 2000s, it became, more of an institutional business. So in 2007, you had a market rate of, call it roughly, 9%. That's the IRR that the policies were bought at. You had the Great Recession in 2009. It went up to about 18.5%. And the reason why it went up so quickly was because you had a huge volume of policies that hit the tertiary market because banks pulled their credit facilities, and almost every group out there had a premium finance line. You also had a lot of the big investment banks that just shut down their desks and liquidated their portfolios. And then you had seniors that were hurting for cash and basically went out and tried to see if their policies had any value. And you had a lot of companies that that basically basically closed shop. And you had a real cleansing of the space. And then in the time since then, you had a lot of regulation come into the space. You had more permanent capital sources, private equity players, large hedge funds, balance sheet investors come into the space. So it became the second level institutionalization. Now it's considered a socially responsible investment. It's very mainstream. Still niche-y, but it's become more mainstream.
Essentially no leverage.
Yeah, the kind of the ick factor has gone away because of the socially responsible nature of the space. And so today it's not a leverage space. So you have potential liquidity crisis, but the investors in the space tend to have a lot of liquidity. The portfolios tend to be mature and seasoned. What that means is the amount of death benefits that are coming in are equal to the amount of premiums you have to pay. So forced liquidations aren't being required at as high levels. And so it's the industry is a much better position. We've been very fortunate at AIR Asset Management. We've brought in over 100 million in new subscriptions this year, a small little firm alone. So we've had a boom year, and performance has been strong. So obviously bigger, more mature players may have received more redemptions, but for us it's been good so far, and opportunity has been great.
Rich, can I touch on something here? Just a little bit more specifics on how we actually protect ourselves. And I can only speak to ourselves and our partners, but typically what we will do and our partner is we will keep premium reserves. And so I know for our fund in particular, we will keep a 9-month premium reserve just in case there is a situation where subscriptions are not coming in and there is that essential liquidity crunch where there's a need to sell policies. Now remember that there is a very deep tertiary market. So we feel that if there were ever a situation where we needed to sell policies in order to raise cash for liquidity, we do believe that there's these would not be distressed sales in any way based on the appetite out there from institutional investors for policies. The second thing to keep in mind is that there's also a gating function to the funds. And typically what that would entail is if 10% of the net assets leave the fund in any particular quarter, the fund has the right to gate in order to protect investors from that mass liquidation. So you have a couple of things in place. You have premium reserves, you also have the ability to gate.
Yeah, and those are common features across not just our funds, but many funds across the industry.
Thank you so much for the details on that. We have time for a couple more questions here. Next one, can you show a return history for the fund as well as a strategy and correlation with equities/fixed income?
Yeah, we have a lot of information that shows the non-correlation of our funds to other asset classes. I would be happy to share that with you. Obviously, this isn't the appropriate forum for that. So we pulled up our contact information. So we would just need to verify your accreditation status and be happy to share that information and get on the phone with you, if interested. So thanks for the question. And we definitely are non-correlated and have the data to show that.
Perfect. And there were a few questions of just how to contact the team. So this is Lindsay with Family Office Networks, and I will make sure that everyone gets a follow-up so we can get you in contact with Richard and Scott directly. Gentlemen, is there anything else you would like to add before we sign off for the day?
I don't think so. I think we covered a lot of ground. You know, the asset class itself is, you know, I think conceptually it makes sense. Buying a policy, taking over ownership of that death benefit, paying the premiums. So conceptually, I think it makes a lot of sense. And I think as folks take a deeper dive into it, they really embrace the component of it, which is that what we like to refer to as that socially responsible aspect, where we're providing much needed liquidity to these policyholders, and in turn, investors are rewarded for doing so. So I would leave that as a takeaway with the audience.
Fantastic. Great. Well, again, we do want to thank everyone, all of our attendees for joining us today. And again, I will be following up with all of you. So if there's any other questions or anything that needs to be connected offline, we can definitely set that up. Richard, Scott, thank you so very much for joining us today. And we will be in touch with all of you soon. We hope you have a great day.
Thank you, everyone. Thanks for joining. Have a great week.
Bye-bye.